Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. We've just updated our capital market forecast for the end of July, and I thought it'd be worthwhile just sharing with you some of the key themes that came out of the work that we've just done and how we then translate that in terms of our asset allocation across our multi-asset portfolios. Our capital markets work is a really important part of our overall investment process because it allows us to be able to formulate a view on our forecasts for financial market returns. We update this every quarter, and ultimately this feeds in to our asset allocation framework and the way that, as I said, we build out our multi-asset portfolios and the way that we look to construct those portfolios, both in terms of looking for the investment opportunities as well as how we can better manage risk across a market environment. And I just thought from the table and charts we have attached here just to touch on a few key themes that we're seeing. First and foremost, at a headline level, we continue to remain constructive on equities relative to bonds. You can see there across the equity market environment, we've by and large got a positive outlook in terms of the return profile relative to the more interest rate sensitive sectors, whether it be REITs and or fixed income directly, as well as cash. From our perspective, certainly those more defensive asset classes that have done exceptionally well over the last 12 to 18 months are most likely going to struggle through the recovery phase as bond yields start to move higher. That may be still some way away, but in terms of the way that we're positioning portfolios, we still believe that, as I said, the outlook is not as strong as what we would expect relative to equity asset classes or broad-based investments in that context. The second chart here just highlights that in terms of how we're then positioning portfolios. And you can see here that through that work that we've done, we have a positive outlook for equities, and therefore across our portfolios we're carrying slightly higher allocation to equities, whether it be domestic or global, as well as other parts of the market which have a growth characteristic, particularly around infrastructure and real assets, which we believe can continue to add to a portfolio framework, both in terms of the capital but as well as from an income perspective. The second point to note is that for overweight equities or more growth assets within our investment portfolios, we clearly are underweight the more defensive part of the investment market, and that's predominantly through REITs, interest rate sensitive sectors in our view in that context, as well as fixed income particularly and cash. Now, it's probably worthwhile touching on the fixed income side of things because you can see there in the table on the left-hand side of that chart, we still have nearly 20% of the portfolio invested in fixed income. So we still think it plays a really important role from an overall portfolio framework perspective in terms of buffering portfolios where we see extended market volatility or we have a significant sell-off in equity markets. Equally, in the context of our portfolio, we're certainly not out of REITs, whether it be domestic or global REITs. We're just holding a smaller allocation than what we normally would. The overall framework of a portfolio from our perspective is really important. So when we have that diversity in a portfolio, whether or not we're over or underweight a particular asset class, we think that it's really important to, as I said, have that diversity, to have that exposure to broad-based investments within a portfolio in order to deliver both in upward as well as downward market environments. The final asset class where we continue to hold an overweight position is within the alternatives. And the way that we think alternatives from a portfolio standpoint is really to try and deliver a return profile that isn't necessarily linked to either fixed income or equity market environments. Within our alternatives framework, we absolutely have exposure to growth alternatives as well as defensive alternatives in order to be able to provide that balance across an overall portfolio-based solution. In our view at the moment, it's a really important part in terms of, as I said, providing that balance and providing the opportunities that we feel can continue to evolve as we move through the second half of this year and into 2021. Despite the challenges that we're seeing in regards to broader-based economic activity, we do believe that, as I said, having a focus on medium to longer-term growth is a really important part of delivering on portfolio objectives, but ultimately ensuring that you can capture that accumulation through time. As always, we welcome your feedback and feel free to reach out to any one of our advisors, and hopefully this has given you a little bit of an insight in the work that we've done on the asset allocation front, and look forward in touching base again soon. Thanks and bye for now.